When income looks this good, it usually means something else is breaking. MSTY might be the most extreme income ETF on the market. Weekly payouts, massive yield, and direct exposure to one of the most volatile stocks out there. So today we're doing what most investors don't. We're putting MSTY through a full back test. Not to hype the income, but to see what actually happens when you reinvest, partially reinvest, or take the cash. Because when yield gets this aggressive, the question isn't how much does it pay, it's what does it cost. So stay tuned. Welcome back to Simply Money. So today we're looking at MSTY and we're doing our all-in scenario where I take hypothetically my income portfolio, we put it into one fund and we see how it's done. And we do different scenarios of back testing on dripping 100%, 50%, or no drip at all. And each row reflects the distribution earned for the week and reinvested on the actual payment date and that day's price. So we're going to look at this, we're going to pull out the sheet, and you're going to see something very interesting with MSTY. So stay tuned to the end to catch that. Okay, so what we're looking at here on the worksheet is you can see that as of April 4th, 2024, we had $191.15 share price. This is all adjusted for the split, so you don't see a big jump. Everything's just been adjusted. It works out exactly the same in your numbers. Now, I have here that it's a weekly payer. It started out a monthly payer, and it wasn't until November of 2025 that it turned into a weekly payer, and that you'll see the adjustment on here as well. With the $525,000 portfolio, that would have got us 2,747 shares. Now, for those who are new to the channel, thank you for joining us on Simply Money. What we do in this scenario is we pretend that we took my whole income portfolio. We started this several months back. If you follow the channel, you'll see the actual portfolio that I do updates on once a month, and you'll see that. But we're sticking with the same number that we used just to keep all of these scenarios exactly the same. If you like these worksheets, you can get a copy in the description down below at Buy Me a Coffee. And all these yellow cells are what you can change. So you can change when you start, how much you invested, and then I'll show you some other things over here we can change down the road. So what we're doing is we're going to look at the share price, the distributions, 100% dripping, 50% drip, and no drip, and kind of see these different scenarios. What's your thought on MSTY? Do you think a fund, and we're going to look at this here, column B, it's just from what we're seeing right here, you can just see the massive decline in the NAV. Do you think a fund like this, you can still make money? Leave a comment down below before we get started. I know some people are going to cheat. Some people already know. But if you don't know, go ahead and leave comments down below. We'll dialogue about it. Continue watching the video to the end because you might be surprised at what you see where you can still use a fund like this to create a strong total return. And bottom line is that's what matters is total return. I don't care if you're paying me a 200% yield. If I'm losing money, it doesn't matter. I don't care if you don't give me any yield. If I have a 200% total return, I'd be ecstatic. So let's look at that and we'll keep that in mind. And I'll try to reply to all comments as I always do. I appreciate you joining me. Column B, you can see the share price. It is just plummeted. It's a very volatile ETF here that it's following. These prices are just plummeting as we come down to where we're at now in February of 2026. 24.57. We're down 87%. That is a huge, massive decline in your share price. And don't get discouraged yet. Keep watching. You're going to see something that makes us realize, wow, that actually works. And you'll have to follow along to understand how that works. So your distributions this first month was $20.64, which would have paid $56,000 this first month. We reinvested, so we were able to buy more shares. We got about 350 more shares, and that's adding up here in this column. As we come down, you can see how volatile these distributions were. $20, $20, $15, $11, down to $9, then back up to $20, then $22. And again, it just bounces, but it keeps going down after that. We bounce back up here in June of 2025 to $11. But look at these payments. You got $102 for the month. You got $124 for the month. Again, you're reinvesting, buying all new shares. So all this is just buying more shares, and you're accumulating massive amounts of shares when you're getting this type of payment. Then we come down here where we get into the weekly pay. And so now you can see that it's going to drop from $5 down to 96 cents, 84 cents, but you're getting this weekly now, 13,000, 11,000, 11,000. Just want to come down. Again, the distributions just keep getting smaller because the yield is based on the percentage of this share price. As your share price drops, your distribution drops, but your yield remains about the same. But you're on a lower share price, so it makes it look a lot worse. But your distribution is dropping drastically here. Now, if you add this up, you're looking about $25,000 a month, where here you got $110,000 for the month of June. If you come down to the end, you can see that it is paid. Get this. Now, this is just in this short period of time, just under 2 years, it has paid $1.4 million in distributions that you've reinvested. But here's the scary part. Look at this. You've reinvested this completely, $1.4 million. Your portfolio balance over here in column I was at $525,000. We got into the red. We had a nice run here where end of 2024 into 2025 where our balance was up over $1 million. So if you had done that and you're like, okay, I'm going to cut my gains, I'm going to sell out of this, you've doubled your money in this short period. But since then, it has just plummeted, and now your balance is down $110,000 from its original. You're down to $414,000. That's a 21% loss in 2 years. Will it rebound? Will it get back into this range? I don't know. We'll have to watch and see. But that is scary when you think about you've been reinvesting dividends for all these years. For these 2 years, you're up 14,000 shares. You've gained 14,000 shares, and you're still down $110,000. All right, let's look at scenario 2. This is the 50% drip. And again, I get a comment. It never fails every video. So I'm going to say it. Those who watch the channel, laugh along with me, join with me as we encourage those who are struggling to understand this. I apologize if I have not made this clear, but this column E is 50% drip, meaning we're getting the distribution, and this represents 50% of what is distributed to you. This amount that you see in column E, you can say, okay, I'm taking this $28,000 and I'm buying more shares. And it's right here in column H. We added that by taking $28,000, dividing it by the share price, and we add the shares gained over here in column H. But you also get $28,000 in cash that you're keeping because you're only dripping 50%. So this column shows what 50% of the distribution is. And so you're getting that 50% and you're reinvesting it. And you're also getting another 50% because you get the full distribution. We're only reinvesting 50%. Hope that makes sense. So you'll see this. Just imagine you're getting this amount in column E twice. One time to reinvest, one time for cash. So as we come down this column, you can see that, again, you're getting a nice, healthy distribution each month. Let's look here in June of 2025 where you got $110,000 on the full drip. Here you got about $61,000 if you take this and you multiply it by 2. So it is down significantly, but it's still a very healthy distribution of $60,000. As we come down here, when we're getting paid weekly, we're getting this 2 times. We're getting this $2,900 to reinvest, $2,900 to have as cash. Come all the way down to the bottom, you can see we've only gotten, I say only, $455,000 in distributions that we have reinvested. So we've gained 4,000, almost 200 shares. But we also got $455,000 in cash. And that is the amount that we've taken home and we've spent, we've done something else with. And we'll have to remember that because that's important when we look at our total yield. You always have to take what your portfolio balance grew or shrunk and how much distribution you kept, because that distribution that you keep is very much a part of your total return. Looking at the portfolio balance in column J, you can see we get into the red a little quicker and we stick in the red for quite a while. And as we come down to the end here, get a little in this red, $170,000 balance. But we gained $455,000 in cash that was paid out to us. And so our portfolio balance is down $354,000. It's a 67% drop in portfolio balance. If I was looking at using this as a portfolio, that would not make me very happy, but there is a way to use this, and we're going to see it now, and I'll explain it in a minute. The final column here is zero drip. Means you're taking the distribution off these 2,747 shares and you're just keeping the distribution. You get them 56,000. You're just taking that cash. You put the money in, it's paying you cash, and you're doing what you want with it. Maybe you're using some of it for living expenses, and then you're reinvesting the rest into something else, and you're seeing this distribution come to you on a monthly basis. We come down here to the weekly as it starts paying out. You're getting $2,300 a week. And as you can see, it just keeps going down because this distribution rate, this share price is all coming down, and you're not gaining shares to keep that higher. But I want you to see what happens here. We received $616,000 in distributions in this, we'll just call it 2 years. It's been 22 months. You received $616,000. So you received more than you've put into your account. And your balance, as you can see, we're deep down in the red. Sorry, this should all be red. I don't know what happened here. But anyways, you're down to $67,000. So you wouldn't put this in and live like this and then just let your account drain in 2 years, because your account balance is down $87,000. But here's what I want you to look at. Total return. Check this out. With full drip, you're actually negative 21%. Because you put the money in, you're buying more shares, but the NAV is dropping way faster than the distribution is making up for it. So you're just seeing that loss in the total portfolio balance. Now, if this rebounds, yes, you have a boatload of shares and it'll pay off. We don't know if it's going to do that. And that's not what these are designed for. These are designed as income producing. Now, some people like to accumulate shares and then start drawing down. Look what happens with the 50-50. You lost $354,000 in your portfolio balance, but you took out $455,000. So you actually had a $100,000 gain. In 2 years, that's 19%. So we'll just say roughly 10% total return annually for 2 years, cash producing. Nothing fantastic. I mean, it's solid, and a lot of people would be very happy with getting 10% year over year for 2 years, but nothing spectacular. Now with the zero drip, you're just taking the cash, you're running your balance down. You're down to $67,000, $457,000 reduction, but you took out $616,000. So you had a gain of $158,000 or a 30% return. Again, over 2 years, that would average out to 15% return, total return on this. And that's where a lot of people will use a fund like this. Again, you're not going to put in, unless you have millions of dollars, you're not going to put in $500,000 into something like this. But if you were to put in $5,000, $10,000, and again, I'm not telling you to do that, but how people will use it is they will put the money in and let the balance run down, and they will take this income out and continue to reinvest into something else. So in 2 years, you've generated $158,000 off of that portfolio, and you were able to invest $616,000 into, say, something else. Maybe you put it into a growth fund or something. So those are just things you can look at and see how you can use these funds differently. Again, MSTY is a very, very volatile fund. It has been on a detrimental spiral over the last year. What's going to happen in the future, we don't know, but that's how you can play with that and see what it can do. What we do over here is we can adjust the drip amount. So if you don't want to do 100%, 50%, or zero, you can put, and we put here 70%. And same thing, then it shows you how you've done. And here we've down 53%, but we've taken out $323,000 in cash. We reinvested some, and we have a balance of $244,000. So it's just different ways to play with it and see how you can work these to the best return possible for your portfolio. What are your thoughts on this? I know a lot of people, they just want to see the income. A lot of people want to accumulate shares. Do you own MSTY? And if so, what's your approach? What's your strategy? If you own similar funds, other covered call, high yielding funds, what do you do with them? How do you work them? And have they performed like this? If you watch the channel, check out some of the videos we have on the all-in scenarios, you will see that some of them have an increase in the NAV. And so doing the full drip actually obviously does better. But in this scenario, this is one of a couple we've done. There's another one that you can find on the site that shows the same thing, that you actually make out better total return by taking the cash, because you're not losing value. You're taking the cash and then you can do something else with it. And you can actually, some people will add to the total return if they took this cash out and invested in something else, what the return that is producing, and add it to this because they feel like, hey, I put this in, it's producing this along with that. I don't do it that way. You have to make your own decisions how you calculate your total return on your investments. But that is MSTY. It's a scary, scary fund for a lot of people. I do not own MSTY, just so you know, but I wanted to share with you the data because a lot of people have asked me about this one. And here it is in all of its chaos and all of its red numbers, but its total return, as you can see, by not dripping, about 15% per year. I appreciate you joining me, and we'll see you next time on Simply Money.